Finance Minister presented the Union Budget for the next financial year today. It was a budget of many firsts, as we all know. There were 3 or 4 key points in the budget. The first is consistent direction. The biggest thing is that the fiscal deficit is projected to be maintained at 3.2%, which is in line with the long-term fiscal policy. It is very creditable, accompanied with reasonable estimates in terms of growth in tax revenues. The expenditure is proposed to grow at around 8.5%. The indirect taxes, given that the GST is being rolled out this year, are estimated to grow at about 8%, while the direct taxes are proposed to grow at around 15% next year. This, I think, is very creditable, especially given the fact that we will have the CBDT will have a lot of data available to mine, which can certainly surprise us positively on the upside in terms of tax revenues on the direct side. In terms of consistency, again, the consistent focus on the rural and the farming community, the consistent focus on infrastructure, and most importantly, the consistency in tax policy were important. As we know, as a precursor to GST rollout, there has been no major changes proposed in the indirect taxes, and on the direct taxes as well, things have been broadly left in place. In direct taxes, one important clarification which came regarding FIIs in terms of indirect transfer, taxability of indirect transfer for FIIs. That was a very positive move taken by the markets. The markets did anticipate and were somewhat worried about the tax on long-term capital gain being modified. That has not happened as well. That the budget really focused on was reform measures. The big thing was the FDI's policies proposed to be liberalized and probably accompanied by the abolition of the FIPP going forward. There were other small reform measures announced as well, like moving to an accrual accounting for railways, which is a very, very important thing. We have already had a cash accounting, which actually is not very fair accounting. And the third and the most important thing is a move towards transparency. There are 2 key areas it reflects in. One obviously is in terms of transparency of political funding, and if we have more transparency there, it's going to be useful. And secondly, in terms of the government trying to move to a system where cash transactions only up to rupees 2 lakhs, 3 lakhs will be allowed. These are the 3 key takeaways for the budget. Thank you.
So I think the budget has been well received by the equity markets, and it's our view that investors with a long-term horizon can look forward to better equity markets over the next few years against the backdrop of the current budget. Just to stress on a couple of points within the budget, I think it does a lot to make sure that the agriculture sector gets its due share of attention. That's a sector that's been actually pulling down our growth rates, and in the past has been fairly volatile in terms of year-to-year performance. So I think from the demand perspective, this is very positive, especially at the consumer goods levels. The basic, not so much maybe from the durables, but at least on the staple side, we should see a better demand environment going forward. So that's clearly a big positive. And I think in terms of the government's commitment also to raise not only incomes but also the farm incomes, and along with that the productivity, would see an increased spend on irrigation. I think the second very important point clearly is on the rural sector. So this is a government which is trying to reach out and improve the social sector spending and also eliminate poverty, and not only do this but at the same time using these as engines of growth for the economy. So I think the very fact that constructing, whether it's constructing houses, what it means from an equity market perspective is that incomes at the lower end would get a boost, would be less volatile and a little more predictable. All in all, I think what the budget does is put India on a fairly robust growth trajectory compared to a lot of several other emerging markets, and coupled with the fact that the overhang on FIIs in terms of the indirect tax transfer has been addressed, we think that there is a case for greater allocation to India even among FIIs. The local allocation has been continuously rising, and we think that will also continue. Thank you.
Hi. Today's union budget was unique in many ways. Firstly, it was the merger of the railway budget with the general budget that we saw for the first time. Secondly, this budget does away with the classification of plan and non-plan heads. Thirdly, during FY18, we would see the rollout of GST, which could make revenue forecasts somewhat difficult. And finally, this budget came in the backdrop of demonetization exercise. In spite of these challenges, government has struck to the path of fiscal consolidation by announcing a fiscal deficit target of 3.2% to GDP, slightly relaxed from the original FRBM target of 3%. For the bond market, the most keenly awaited number was the gross borrowing and net borrowing numbers. So the gross borrowing for FY18 is pegged at 5.8 lakh crore. This compares with a gross borrowing of 5.81 lakh crore for FY17. The net borrowing is pegged at 4.23 lakh crore, and there is also a 75,000 crore buyback which is also estimated. Net of the buyback, the net borrowing figure falls to 3.48 lakh crore, and hence this implies that 65% of the fiscal deficit would be financed through market borrowings. Post-budget, we immediately saw a negative reaction with gilt yields rising by as much as 5 bips. However, currently the gilt market prices are trading neutral to about 5 to 10 paise up. So all in all, if we analyze the budget from a debt market perspective, the quantum of gross and net borrowing announced is fairly comfortable for the market. In fact, it is on the lower side of most of the estimates of market participants, which we feel is positive for the gilt market. Added to this, we have ample banking system liquidity. Hence, we expect money market rates to remain benign. As far as the long end gilt and corporate bond yields are concerned, now that the budget, the main event, has been done away with, market participants are expected to take cues from the RBI policy, and expectations of rate cut would be a key factor which would drive the bond market going forward. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.